Is putting your retirement money in the stock market the best thing to do? Well, in my opinion, it's not. And in today's video, I'm going to give you even more reasons why it's a horrible place to keep your retirement money. I've made videos like this in the past, and here are some more examples of why it's not the best place to put your retirement money. Stick with me on this, and I think you'll enjoy it. I'm Victor Cuevas, Victor for Advice, and if you like this video, please share it with those you care about, and like it if you would please. Now let's get on with it. I'm in my Financial Advisor magazine here. I have an article to show you from May 2nd of this year. Very disturbing headline. Bill Gross says total return strategy he pioneered is dead. Now let me give you a little history. Bill Gross is considered the greatest bond trader there ever was. And in the 80s, he started a bond fund, the PIMCO. You may have heard about it. And it turned out to be the greatest thing in the world. And he was the king of bonds. And anybody that had a 401k had his bond funds in those 401ks. But here's what he says now. Bill Gross, who pioneered the total return strategy in the 1980s that revolutionized the bond market, says the approach is now defunct. Now here's the biggest bond guy ever, and let me show you, cut to the chase here, what he says at the end here. Those that argue for lower rates have to counter the exorbitant upward climb in the treasury supply and the likely Sisyphean decline in bond prices. I know it's kind of a weird statement, but here's what he says. Gross, who retired from the money management business in 2019, wrote, "Total return is dead. Don't let them sell you a bond fund." He's saying don't let your financial advisor put you in a bond fund. Well, where do you go for safety? This is what the securities guys have always told you. And remember, I've been in the securities world for a long time, 20 years, licensed. I was a fiduciary. We use bond funds a lot. And they always tell you that's where you go for safety. That's where you go to reduce the volatility in your portfolio. He's saying don't let them sell you a bond fund. Now, when Bill Gross says that, when he was the king of the bond funds, you might want to listen. And it ends by saying that over the nearly 3 decades, Gross built the PIMCO Total Return Fund into the world's largest bond fund at its peak and cemented his reputation as the bond king. He was ousted from PIMCO in 2014 after falling out with other executives. So what I've said in the past is that this century, the 21st century, changed everything in the securities world. That's why I left it. And he saw that change coming even in the bond fund industry, in the world of bonds. He had such a falling out with all the other executives that they forced him out of his own company. Can't make this stuff up. So are the financial advisory wizards out there the best people to listen to on these subjects, on where to put your retirement money? Well, let's look at someone else. Now, in this article from April 29th by Jacqueline Sargent, it reads, advisors need to rethink their diversification strategies. Morningstar says, well, Morningstar is the #1 rating agency in the world on mutual funds. And diversification is something that all financial advisors talk about. You have to diversify. You have to put your money in all these different buckets so that you can manage the risk, reduce the risk in your portfolio, and you have a better chance of having good long-term results in your portfolio. And when you are in a 401k or an IRA, well, you're on all kinds of mutual funds across all types of asset classes, and that's diversification. And she goes on to say, talk about the 60-40 portfolio. Now that's been the big deal in 30 years, where 60% of your money goes into a stock portfolio, stock mutual funds, and 40% goes into bonds. And if you do that, well, when the market isn't doing so well, your bonds will do well. And then when the bonds aren't doing too well, the stocks will do well. And that way you kind of smooth out these ups and downs. And when the market is tanking, your portfolio won't go down as much, and you'll get protected from, getting hurt really badly in the market and all these neat things. And over the long period of time, they say the 60-40 portfolio has done better than most things you could do. Okay, but now they're talking about the diversification isn't working all that well anymore. So the author of this article talks to this expert, Amy Arnett, and she's going over the different places you can diversify your money. And she says, as for bonds, she said, when equities are under stress, we have seen bonds perform quite well. That's the way it's supposed to work. Not always. The Fed is often lowering rates in that recessionary environment when stocks drop, and Treasury bonds are often seen as a place to be in a flight to equity. Of course, when the Fed gets involved and starts running up the interest rates, those bonds aren't going to keep up. And she's talking favorably about bonds, but we just saw where the king of bonds says don't even go for the bond funds. Don't let them sell you one of those bond funds. She makes this statement about bonds: I would just be careful about where I invest my bond assets. So she talks favorably about it, but then you really have to be careful where you invest your bond assets. Okay, then you go into commodities here, and they're, stocks are up 1%, some percentage, and then commodities beat them. And then the following year, the commodities tank 8%, and equities go up. So that gets kind of complicated when it comes to diversification. She talks about gold, likes money in utilities as being good, but then she goes over here to real estate and says the real estate was cited as another sector that has seen diminished value as a diversifier, and says 20 years ago it was a go-to sector for counterbalancing equities, but performance has become more closely correlated. In other words, back in the day, you would say, you have your stocks, but you want to own some real estate, because when the stocks aren't doing right, real estate is doing better. But now they're saying, well, they're more closely correlated. So now that means when the stocks are tanking, so is the real estate. That's not very dependable. And she goes on, talks about Bitcoin and other things. But here is the bottom line I want all of you to grasp. The bottom line, Arnett said, is that diversification is the core principle of sound investing. In other words, if you want to be a sound investor, you have to diversify, right? Spread your money around different asset classes. It goes back to the idea of not putting all your eggs in one basket. Okay, fine. But here's what she says. Advisors, she said, can add value to their client relationships by emphasizing that it's impossible to predict which asset class is going to perform best or worse, and that's why it's important to hold a variety of asset classes. So in this article, you read all this mumbo jumbo about all the different asset classes and all the different uncertainty. And then at the end, she says, well, when you're talking to your clients, you got to emphasize that it is impossible. That's what she says, impossible to predict which asset class is going to perform best or worse. And that's why it's important to hold a variety of asset classes. So basically, here's what happens. You go in to see your Edward Jones guy or your Ameriprise guy or whoever. Say, here's my retirement money. What am I going to do? And they'll throw you in 20 or 30 mutual funds. They just spread it all over the place. We got to protect you. We got to make sure that whatever happens out there, because we don't know, we have no idea. It's impossible to know what the market is going to do and which asset class is going to perform better than the other at what time of year. So we just got to really diversify you. You're good to go now. What a bunch of baloney. It's a crapshoot, as I have said in the past. That's how you pay these guys 1.5%, 2% or more comes out of your account if you're working with a financial advisor, or if you have a 401k, Lord knows it could be anywhere from 1.5% to 4% worth of fees that come out of your money. For what? For these guys, people writing articles, big time financial advisors, for them to say, well, you know what, it's impossible to know. We just have no idea what asset class is going to perform better this year or that. I don't know, real estate, gold, Bitcoin, commodities, stocks, bonds, high yield bonds, treasury bonds, corporate bonds. We don't know. Impossible. And you want to put your retirement money in something like that with those people? No. That's where the fixed indexed annuity comes into play. You put it in a fixed index annuity. It earns compounding interest, wealth that builds on itself, not just up and down stuff. So it's tied to the market. Your money is not in the market, but it's tied to a market index. And when the market is doing well, your money goes up. And when the market drops, it stays right there. It doesn't go anywhere. What do you care about diversification? The indexes are diversified. Even the S&P, you might be in the S&P 500. That's 500 different stocks. You're well diversified. You can, some of those, in those stocks, in those indexes are managed for volatility. Just leave it in there. And you don't worry about what the stock market is going to do. You just know that when the stock market does well, you make money. And when you make money, you earn interest. It's locked in. You can't lose it. And when the market tanks, what do you care? You keep your money and everything it's gained before the market tanks. But you know what? It gets worse. Now, this is a pretty good article about the spectacular past and the concerning future of the 60-40 portfolio. Now, this was written by a guy. This guy has an MBA, class of 1975. He's a senior lecturer in entrepreneurial management of Harvard Business School. This guy teaches, he's a professor at Harvard Business School. And he's writing this article. So I'm reading it. So he's talking about how the 60-40 portfolio was great in the past. And over from 1961 to 2021, it averaged 9.3. That was the annualized return before fees. Knock off a couple of percentages minimum, and that's where you're at. So he shows the future, and then he says, will the next generation receive rewards, generation of investors, receive rewards for investing in the 60-40 portfolio comparable to the past two generations? Unfortunately, this seems extremely unlikely. So he goes on to say here that we predict a 4.4% annual return for the 60-40 portfolio. Now, the 60-40 portfolio is what they'll want to put you in when you retire. You can't be 100% in the market. It's too volatile. 60-40 reduces volatility, gives you some gains while you're drawing out that 4%. But this Harvard professor is saying things have changed now. the future is not going to be the same that way anymore. The 60 portfolio isn't going to work near what it used to work with. And I want you to see how he ends his article. Wall Street has recognized this paradox, and each year they innovate plenty of solutions. Wall Street's always coming up with something new to kind of, well, we screwed it up over here. We got to figure a way to get some better returns than what we've been doing lately, guys. Some of these are legitimately attractive, and some only look attractive at first glance but become less compelling when analyzed in more detail, with hidden fees, confusing vehicles, associated risk, liquidity leverage, and other drawbacks. He's laying it on the line. At least he's being honest about how wacky this world of the securities world can be. Finding the right alternative, listen to this, finding the right alternative for safe, secure, and attractive investment like the 60-40 historical portfolio, the way it used to be, is a huge challenge. Investors owe it to themselves to seek solutions that give them the kind of high single-digit returns with manageable risk on their portfolio that they have come to expect, and not just accept the 60-40 portfolio as the only available option for the future. In other words, he says the 60-40 portfolio, don't count on it anymore. What are you going to do? He says finding the right alternative for a safe, secure, and attractive investment like the 60-40 historical portfolio is a huge challenge. No, it's not. Here's a guy with a master's degree. He's a professor at Harvard, and he doesn't even know about a fixed index annuity. Oh my goodness. Listen, finding the right alternative for safe, secure, and attractive investment is not difficult. It's called a fixed index annuity. And so this is what people want. They want a secure retirement. They want it to be safe. They're not getting it in the securities world. They're not even getting it in the traditional 60-40 safe and secure, quote unquote, portfolio. Now, Harvard professor is saying it, but he won't tell you is that there is a solution. It's not difficult. It's easy. Your money goes right into a fixed index annuity. You're done. You can be diversified. You can be in 2 or 3 or 4 different indexes. You can be highly diversified. The indexes themselves are highly diversified. You can be as diversified as you want. It's safe because you'll never lose your money. It's secure. And whenever you do make money, it's locked in. You keep it. It comes to you as interest, compound interest. Easy, easy, easy solution. But these guys, with all their education and all their experience, don't want you to know about it. And why? They can't collect that fee. They will complain about guys like me who work for a commission because they feel that I'm not operating in your best interest, while they want to collect a fee and won't tell you how you can have a safe and secure retirement. Who's acting in your best interest? Not them. They're acting in their best interest because they want to retain the fee. They need to have assets under management, 10, 20, 30, 40, 50, 100 million, so they can get that fee income. And if you're in a fixed index annuity, safe and secure, growing nicely, compound interest, they can't collect a fee. They won't tell you about it, even if they know. I'll finish with this. I found a 60-40 portfolio calculator. I put in 1985 to 2004, January to April. Put in $500,000. And this is a different type of 60-40 because you're very highly diversified, even more so in this portfolio. I mean, this is a very highly diversified 60-40 portfolio. It's all in iShares. And we see by the time you go from 1985 all the way to now, you've grown your money to just over $7 million from 500,000. So you're saying, wow, that's pretty good. Well, sometime around here, you're going to retire, right? So you're going to start drawing that income down. So let's suppose this guy's 85 and he wants to retire around the year 2000, right? And so we come over here and we find that in December 1999, the account has grown to $3.2 million, $3,233,000. Pretty good. I mean, the 1990s was crazy for the market. But the dot-com bubble bust, and by the time you get to September 2002, he's down to 2.3. He's $900,000 down. But he's retired, remember? He's been drawing money out of this account the whole time, plus fees have been coming out of the account the whole time. So we go to December 1999, he's going to retire the next month, and he's sitting on $3,233,927 and wants to retire. Well, back in those days, they would have told him to take 5% a year out. Hey, this market's going great. Go for it. You can take 5% a year. No one's going to tell you to do that. It's only 4%, and some saying 3.5%. Let's say 4%. Well, he's going to draw out $129,357, almost $130,000. But you're going to have to take 2% out of that for fees. So quite a lot more is coming out of there. So if we're looking at 29,000, so if you're looking at 2% minimum in fees coming out of that account, all total, that's almost $65,000 in fees coming out of the account. The client is taking out 129, so now you had $194,000 came out of that account that first month. If you take it in one lump sum, you could take it in a monthly, but altogether that year, $194,000 is coming out of the account. Well, when the market starts to drop, as we see here, $19.99 he retires, the market drops 9.8% the first year. Is he going to take $129,000 out of that account? Let's say he does. So now he takes 129 out, the 2% of fees come out, and subtract 9.8%. All right, so it's, well, it was a one-off. Next year it'll come back. The next year it goes down 11.2%. Is he going to still take 129,000? And then the next year goes down 1.6. So he goes 3 years in a row taking money out. It goes up 28.6%, and these are true historical returns. That's not even going to break him even. He goes up less next year, and the next year he's flatline. He got 2 more years, and then 2008 hits, and he's down 25%. And this is a 60-40 portfolio. Everybody else went down 40 to 50%. He's been taking money out, and if he's been taking at 128,000, he's probably down around 1.5 mil, 1.6 mil. He's in trouble. You get a couple of more years, and then you're back down. A couple of more years, you're back down. A couple more years, you're back down. 3 more years, you're back down. And then in 2023 goes up. That's not the way you want to retire, folks. You want to have your money in a market retired like that? And that's a 60-40 portfolio. Well, Victor, I'm going to put only 30% in the market and 70% in the bonds. You just heard from Bill Gross that says, don't get the bond funds. You've already heard from another expert, a Harvard professor, to saying the 60-40 portfolio is barely going to do 4%, no fees. What happens when you take 2% out of that 4%? Now where you're at? You're done. You're toast. I don't. Once you're educated on this, I'm sorry. I just don't see how you can leave your money, your retirement money, in the market when you want to retire, or even 5 or 10 years before retirement. When this happens, this is the new century. So what if he had been back here in 1999 and put it all in a fixed index annuity with an income rider? Let's suppose, just to make it simple, he just wanted to convert it all into income. And we can do that without annuitizing it, which means you have total control of the money. So he gets an income, and let's suppose it's still the same $129,000. Now with the income annuities, it probably could have drawn out. Probably with the draw, it would have been maybe 5.5%. But let's keep it at 4. Is that 129,000? 3 years go in a row. Let's suppose the index he's in doesn't do anything. It's below zero. Well, he's not going to lose any money in his portfolio. The only thing that's coming out of his portfolio is that $129,000. That's never going to decrease ever. And he can have an index. He can have an income rider with an increasing income that goes up whenever the index is positive. So he goes 3 years. He keeps the same 129. He's not worried about it. Everybody's going, oh my goodness, this is the 3rd year in a row. The market has come down. I'm taking money out of my retirement account. I'm toast. And the person in the fixed index annuity is going, what do I care? Not going to affect me. Then the market goes up 28.6%. Well, the other person in the market, he hasn't even broken even yet. Is he going to go back up to 129? Is he going to stay at 129? Spend his account down? But guess what? Let's suppose that index conservatively returns 10% that year instead of 28 point. Because they're managed indexes. They won't do the 28. They'll do 8, 9, 10, 15%, depending. Could it be 20%? Let's say it's 10%. He gets a 10% pay rate. 129,000, add 10% to that. Oh, look, 12.5% the next year. Add another 5% pay raise. This guy here, he can't give himself a pay raise. He's still hoping to get out of the hole. All right, the market is flatline. Now, when you have markets like this, and like this, good possibility the index is still positive that year because it's a managed index. So that index, the stock market did 0.1%. That index, or negative 0.1, that index might have done 3% that year. Let's suppose it did 3%. You get a 3% pay raise. Pay raise. Pay raise. Stay where you're at. Pay raise. Pay raise. Stay where you're at. Pay raise. Pay raise. The guy in the fixed index annuity is getting all these pay raises. This guy won't dare give himself a pay raise because, look, he did this and he did this. No, he's in the hole. He's way behind. Even if the person with the fixed index annuity runs out of money in that annuity, all the money is gone because he's getting pay raises. I mean, he might be up to $200,000 a year at this point. He'll draw that. Well, by the time he's 80 years old, all the money is gone in that annuity. What does he care? He doesn't care. Why? He's going to continue to get his income as long as he lives, as long as his spouse lives, and that income will continue to go up when the market is positive. I want to ask you, why in the world, anybody wants to put comments down, why in the world would you want to go into retirement and end up retiring with your money in the stock market when you can be in a fixed indexed annuity and not have a worry in the world. We call it the don't worry, be happy retirement. That's where you need to be. I read this stuff every day and none of it is good news. And these guys convince me day after day that they have no clue. I just showed you Harvard professor, no clue. The other person, supposed to be a top-notch financial, she's got no clue. Just diversify and hope for the best. Cross your fingers, hope for the best, and stay diversified. Now, just get with me and find out how you can protect your retirement nest egg and have a safe and secure, don't worry, be happy retirement. Victor Cuevas, please push the like button if you like this, and share with people, and subscribe, and hopefully we'll get to talk to you soon.